Before we dive in, just wanted to give a quick shout out to Matrixport, the sponsor of this week's episode and one of the fastest growing, largest digital asset platforms based out of Asia. More on them soon to come. What's up, everybody? Welcome back to the weekly roundup edition of On the Margin. Today I am joined by not one, but two dynamic co-hosts in the form of Tyler Neville and Casey Wagner making her debut on the roundup. What's going on, everybody?
What's up, Mike?
Hi, excited to be here.
White shirt gang. We really coordinated here. Yeah, if you're listening on Spotify or iTunes, you can't see, but we're all wearing white shirts. Looks phenomenal. I'm also part of the white headphone gang, in case people are missing that too. Yeah.
You know what we look like? Have you ever seen like that movie Divergent? We look like we're in some sort of like cult.
I have seen Divergent.
Yeah.
Not the highest form of cinema. No offense, Shailene Woodley, if you're listening to this, but not the highest form of cinema. I actually, we joke because for those not working at Blockworks listening to this, we have this little please like Slack channel. Reed Hannaford, our head of creative, a little while ago did these headshots, and everyone for a long time at Blockworks had the same exact looking headshots, and everyone would like each other's LinkedIn posts, and we were like, all right, the cult is back at it. There'd be like 8 identical looking people on LinkedIn liking every single post. Yeah, little inside baseball that no one really cares about. All right, let's get into the stories of the week here.
That was your dad joke. That was your dad joke, by the way.
I see. The thing is I have unlimited dad jokes. Completely inexhaustible.
And I also didn't get an adjective this week.
Dynamic. I said both you guys are dynamic. That's a great adjective.
Okay.
All right, fine. All right. Today we're going to be kicking it off with stagflationary warning signs. So Tyler, we're going to be really deep diving kind of into what you pointed out on your newsletter yesterday, which is this divergence in between the Baltic Dry Index, which is a leading indicator of economic activity, and a flattening yield curve and continuously diving yields, most notably the 10-year, kind of telling two different stories about inflation versus deflation. We're actually going to do a debate that Case is going to referee and judge us on here at the end of the day, so that'll be a lot of fun. Second story of the day is a deep dive on crypto exchanges. We have a deep feature coming out next week. You should all tune into the Blockworks site. We're going to be picking on Casey for her deep knowledge there. And then finally, we are going to be getting into commercial bank lending, which has hit record lows. And we can kind of tie that into everything that we're talking about. Financial institutions and inflation versus deflation in general. Sound good, guys? White shirt gang? Incidentally, I made this white headphone gang joke because Brent Johnson used to have those. I was like, Brent, where are the white headphones? And he's like, oh, yeah, I used to have them, but I got rid of them because they didn't look so good. I was like, dude, I'm sitting here with white headphones, listening.
I agree with him.
All right. All right, let's get into our first story here. Stagflationary warning sign. So basically, this originally, I think, came to us from Tavi Costa, but he posted this great chart on Twitter, which is basically this divergence in between the Baltic Dry Index and the 10-year yield. So from Investopedia, the Baltic Dry Index measures the change in cost of transporting various raw materials such as coal and steel. The Baltic Dry Index is often viewed as a leading indicator of economic activity because changes in the index reflect supply and demand for important materials used in manufacturing. And basically, the common sense explanation of that is it's a measure of the cost of freight, basically, for shipping raw materials around the world. So in general, when the cost of freight goes up, it means there's more demand to ship around raw materials, and that goes into that kind of shows the demand for actually producing real goods that are used in the economy. What's interesting about this is that Tavi matched this up with the 10-year yield, which is dropping. And in general, what we're seeing is a flattening of the yield curve. So those yields that are way far off at the far end of the curve, kind of the 30-year, the long bond is at the lowest it's been in quite a long time, whereas the shorter duration treasuries are actually kind of staying relatively stable. And generally, when you have a flattening of the curve, it's signaling low growth. So at the same time that you have the Baltic Dry Index picking up, signaling high growth in the future, you kind of have this flattening of the yield curve indicating low growth. I guess, Tyler, let's pick on you first here. You were the one who kind of pointed this out and wrote a newsletter about it. What's the way to interpret this?
There's just really big divergences in the market, and the bond market is telling you one thing. Historically, that's been correct, right? The bond market generally drives everything. This one's a little bit weird to me because everything is still pretty inflationary if you look at the Baltic Dry Index. And the only thing that really changed in my mind was Jay Powell went from talking about tapering to like, okay, now we're going to talk about tapering, right? And that's what caused the big drop in long duration yields and that snapback in, tech and growth equities. So I don't really see much rollover in inflation or growth personally. So it's partly also a phenomenon of there's too much capital chasing too little assets. So like if you have bond investors see yields rise and they're like, oh crap, now we can make up our gap of pension funds, unfunded pensions, so they go and grab more bonds, right? So I think maybe that's part of the phenomenon as well, is there's just too much capital seeking a home. But if you really look under the hood, we have negative real rates, which is theoretically pretty inflationary, right? Mm-hmm. If you have negative real rates, that means like, okay, you have to go, really out on the spectrum and basically you're gonna be forcing inflation. Inflation is higher than where the nominal rates are, right? So I think that will kind of that divergence between the Baltic Dry and the 10-year will reset and rates should rise from here is my read. What's your read? Yeah.
I'm actually going to turn it over to Casey, who's going to school all of us, because Luke Roman loves her, and he's been talking to her about negative real yields for a period of time. So, Casey, what's your kind of take on real yields, inflation, where you see everything going?
I haven't talked to Luke in a while about this, unfortunately, but I do remember speaking to him several months ago, and he said were going to go negative, and here we are. I want to know how long Tyler thinks they're going to last, though, before we get into the inflation discussion.
God, I think years. The only way
Really?
to finance these huge deficit is to force negative real rates is my read. And we're just going to be in this. Look, the junk bond market, you can issue junk debt at negative rates now. Like, that's insane, right? Mm-hmm. What junk company isn't coming to market right now and issuing debt? Like, you should be doing that hand over fist and buying back your stock. Like, and that's really what we're seeing under the hood of everything. And I think the Fed is, I think they really mean what they say now, where they're just going to keep printing and printing until, we get unemployment dropping. I don't really think they care about the real rates. They want to finance giant fiscal deficits so that growth rates stay high enough. I think that's the bottom line, and they're using all sorts of weird, adjusting language to basically keep those printing presses going, is my read.
Yeah. Well, ever since that interview that you did with Russell Clark, Tyler, I'm trying to find logical explanations or actually reasons why the market is behaving rationally as opposed to just saying, these idiots, what are they doing? How could corporate bonds, especially triple C's, be basically at negative real yields? And the explanation, I guess, like the reason why that's actually pretty rational is because when the Fed jumped in to stabilize markets, specifically credit markets last year, they went right after the junk bond market. So it actually kind of makes sense that you could finance debt at negative real yields, even for basically shitty corporate debt. Because you know that the Fed is going to jump in and save the day. So that's why those prices actually kind of make sense. It feels weird to be talking about, corporate debt as a quote unquote store of value. But if you have the Fed backing you up, then it actually kind of, there's some rationality there.
Well, it is until negative real rates go really deeply negative. And then you get, I guess, eventually people just saying, okay, I'm losing money by investing in debt, right? Inflation's eating me up. So I think that's the big key when pensions say, okay, we can no longer invest in this. We're actually losing on a real basis. But I don't even think that'll happen either, because the boomers, they need to satisfy that yield no matter what. So we're in this like weird post-truth world of perennially negative real rates and if the Fed decides to tighten, the market will force them to not tighten again because it just becomes a liquidity suck.
Yeah.
That's sort of my
What?
read right now. Yeah.
I think a lot of the reason why we have these divergences is because we're split on this idea of inflation versus deflation. If you look at a bunch of different major markets right now, we're kind of in this long period of consolidation, which is boring, but it's also charged because it feels like it's going to move in one direction or another. And I think a big part of that reason is that people don't agree. Is this inflation that we're seeing transitory? Is it going to switch to being disinflationary or deflationary again, or are we entering a period of secular inflation? So we're going to do something a little bit special today. We're actually going to have a little bit of a debate in between me and Tyler. In case I'm calling on you to referee this, and be fair, but know who's maybe do the smart thing and know who's buttering your bread here. No, just kidding. Okay, cool. So
You're both my
Tyler,
boss, so it's hard.
yeah, well. Yeah, all merit. And for those listening, comment in the YouTube thread on who you guys think won. Case, take it away. Maybe Tyler, you kick us off with the the pro-inflation argument here, the bull case for inflation.
Okay,
Okay.
so Tyler, I know you're pro-inflation. I want to ask you something very specific. I read about lumber a few weeks ago, and that's Powell's like picture perfect example of why inflation is transitory because the lumber prices went down. What's your counter argument to that?
My counter argument to that is they were up like, was it 300%? So, of
Yeah,
course,
hi.
assets do not go up in a straight line. So, like, transitory inflation, this was a pullback from a very overcooked level. Does that mean it's transitory? I don't know. What is transitory? I think if you look at oil has done the opposite of lumber. It just continues to keep going higher, and that's like the basic plug for the entire global economy, right? So my read on lumber is that was kind of like a housing boom generated thing where just supply disconnect from all the demand coming. So my bigger indicator is probably oil for inflation. If that really pulled back, then I'd say, hey, the deflationistas that just came out of the woodwork would actually have like some legs to stand on. But I don't see that. I don't see that at all. Mike?
All right. Case, do you have any specific questions for me, or wanted me to just tear apart Tyler's argument there? Just get
Well,
started.
he's making sense. What's your counter argument to that?
All right, so my thought process here is that just the macro elements of deflation just outweigh any of these like kind of secularly rising prices in commodities. So honestly, I'm gonna parrot Mark Yusko here, and I'm gonna go into my D's, which is debt deflation or debt demographics, and I can't remember the third, so I'm just gonna start with debt. But basically, you have a historic ratio of debt to GDP. We're higher than I think we've ever been, including times of World War II. Stan Druckenmiller went on CNBC about 2 months ago, and he said something really interesting, which is that basically at the amount of debt that we currently have, something like 36 cents of every dollar actually just goes in of GDP goes towards paying down that debt, which is a super, super deflationary force because generally what we need in order to see inflation is real economic growth, which drives increased wages and increased prices. If every dollar or out of every dollar earned, you have 36 cents of that going to just paying down debt, that's a super, super deflationary force. The next thing is demographics. And there's two important shifts to mark here. Like people talk about kind of the aging, like baby boomers and millennials in the US getting older. And generally, folks that are older have a preference towards holding bonds because your time preference gets higher. Obviously, you want to hold something that's a little bit more stable because you're entering your retirement. So you don't want an asset that's going to dip 20 or 30% or something like that. So older folks tend to favor bonds just as a risk profile. And it's something like in the US over the course of the next 4 years, I think it's, we used to have 15% of people over the age of 65 are basically non-productive workers. And that's going to shift up to 22%. So that's a big rotation into bonds and out of stocks. But I think the other actually more important thing to look at is Chinese demographics, because you basically have this large labor pool that the U.S., because of our outsourcing relationship to China, we've effectively outsourced, brought in this enormous Chinese labor pool into the United States, which has brought wages way down. So you have something like, which I know you've been talking about, Tyler. Yes. What?
But that's inflationary.
Why is that inflationary? It is if the wages in China start to go up, but
They
still,
are.
like, so. Okay, but to what levels, my friend? To what level? So if you look at the average income of not the median income, the average income of a household in the United States is $84,000. In China, it's still $10,200. So you have to 8x to get them from where they are right now to where we are. And I know in that Russell Clark interview, it's like they could be increasing wages at 4 or 5%. You got to do that a long time for an 8x, my friend. It's still
On a
much,
billion
much lower.
people. On a billion people. That's a lot. That's a lot of more buyers.
It is, but what I'm saying is to still get competitive with U.S. wages, we've still got a ways to go, basically.
Okay. I
Yeah.
gotcha.
Okay, so Tyler, Mike's pointing to wages. What are you watching to prove inflation is here to stay?
Well, a lot of it is a political thing, right? So here's very interesting. Biden came out today. He issued an executive order. And let me read this for a second. It says, greater scrutiny of mergers, especially dominant internet platforms, with particular attention to acquisition of nascent competitors, serial mergers, the accumulation of data, competition by free products, and the effect of user privacy. So if you think about like Amazon being a highly deflationary company and having, super deflationary effects, pricing power was going down for a generation because they basically like unlocked all these efficiencies. If all these platform companies that have basically kept a lid on consumer inflation for years and years are getting essentially broken up, or the ability to consolidate more and more and create more scale is not available, consumer prices will rise. And he goes on in 2018, this is from Wall Street Journal, Biden said the rise of monopolies weakens labor. And so if what he's really trying to do is raise the wages for labor and take the power over from capital is really what I think Biden's doing with this order. And if you have that transition, you get doubly hit. The monopolies basically are squeezed because they have to pay more for their labor, right? And they're going to inevitably, if they don't have this like cycle of like endless scale, they'll have to charge more for their prices. So you get wage inflation and you get actual like commodity and goods inflation. So I think it's a political thing that's really behind the winds of this. Yes, you have, and partly the reason why we're in this position is because of the demographics. It's because of the debt. If they don't do anything, our world just implodes, right? If Biden just lets, if he doesn't pull out giant fiscal guns and anti-monopoly, like our world kind of implodes, right? And that's sort of why I think this is the swing to real inflation. You're going to have giant fiscal plans because you need growth to pay off that debt, right? You need the economy nominally to grow so that they can pay off that 42 cents on the dollar. If they have like meager growth rates, then they're screwed. So they have to pull out the guns. So that's my big push is the political narrative is way more powerful than the debt and demographics narrative. But people haven't gotten around to it yet.
So is the world going to implode, Mike?
Is the world going to implode? I don't know.
know.
I think, okay, so one thing you guys probably saw on Twitter, this was getting passed around as like this really stupid headline from CNBC, which is that the silver lining of inflation might mean higher salaries. And people went off and just had a field day. They're like, who are these morons? What are they writing over there at CNBC? Yada, yada. Media sucks. Okay. Yeah, that didn't look so great the way they wrote it. But at the end of the day, they're actually not that wildly far off. Like, inflation exists on a spectrum. And there are kind of two types of inflation. There's the good kind of inflation and the bad kind of inflation. And the good kind of inflation is just growth that's just overheated a little bit. And that is all about wage growth. That's wages and prices kind of going up in this self-fulfilling prophecy, or like whatever type of cycle, right? And then there's the bad type of inflation, which is that nobody trusts the dollar. So if you're talking about inflation on the spectrum of, hey, maybe it's going up 3 or 4% a year because the economy is rip roaring, then actually that wasn't that stupid of an article. But if you're actually talking about it from the fact that nobody believes in the currency anymore, then yeah, that was like the dumbest article ever written. It's just, a lot of the nuance goes out of it. I think at the end of the day, just like Bitcoin, Tyler and I are both going to be right. Just depending on what your time horizon is. There's probably going to be inflation at some point in the future. There's going to be deflation at some point in the future. I realize that that's a little bit of a cop-out, but, that's kind of what I feel like. Although I do think if you've been calling for inflation for the last 40 years and it eventually comes, you're not allowed to say you were right. I firmly agree with that. You were not right, my friend. You were not right. So that's what I think. I guess we'll have to let everyone in the comments be the judge of who is. Well, actually, Casey, give us our scores here. Who convinced you the most?
I mean, me personally, it was pretty close, but I might have to go with Tyler.
Let's go,
Casey.
Casey,
I'm going to need you to report to HR after this on a completely unrelated note.
I'm sorry.
All right, cool. No, I think, very compelling point, Tyler. Very well done. What's going on, everyone? Excited to talk to you about one of my favorite new companies in the space, a company called Matrixport. If you're a longtime listener of the show, you know we spend a lot of time talking about this crazy environment of low yields that we're all living in. The big question is, if inflation is around the corner, how are we all going to protect our wealth? Well, Matrixport has some really, really interesting solutions I think you should check out. And the big thing is they do so many things, it's almost hard to cover everything in 30 or 45 seconds or whatever we have here. 2 things that I want you to walk away with. 1, they allow you to earn up to 30% yield. 2, they are leveling the playing field between institutional and retail investors. A little bit of background about this company. They are one of the fastest growing platforms based out of Asia. The really cool thing about these guys, they're literally a one-stop shop. Everything you need. Custody, spot trading, OTC, fixed income, structured products, lending, asset management. These guys literally do it all. When they walked me through the demo, my jaw was on the floor the entire time. Here's what they've basically done. All of those crazy structured products that are available to institutions that allow them to earn so much yield, they've basically taken them, packaged them up in a way that anyone can understand it, and they made it available to their entire audience of investors. That is just a freaking awesome thing to do. Very cool mission, but also it allows you to manage your risk in a super sophisticated way and earn huge yields on this platform to protect you from the pernicious effects of inflation. So, for example, you can start earning 30% in APY on USDC today if you go to onthemargin.link/Matrixport. Again, that is onthemargin.link/Matrixport. I don't know what you're waiting for. Go check them out. Thank me later. All right, let's make the shift into talking about crypto exchanges. So let's just start at a really high level here. Casey, I know you're writing an in-depth feature on this. Talk to us a little bit about what's going on in the world of crypto exchanges, how they're kind of being seen, and maybe like the relationship in between what's going on with kind of banks and how they're allowing consumers to get access to assets like Bitcoin.
Yeah, so we're seeing an interesting shift with exchanges kind of leaning into these banking products, and they're starting to take on more of a banking role, kind of alongside banks attempting to get involved in crypto and trying to start offering crypto services to some of their clients. But kind of going back from that, most crypto exchange revenue comes from trading fees. In 2020, Coinbase said that 90% of their revenue came from transaction fees. So pretty much all of it. When crypto had its big run at the beginning of 2021, exchanges obviously reported record volumes. They had a lot of revenue. This isn't likely to continue, though, with the market that we're seeing. And Coinbase even issued a warning to investors on their first quarter earnings call a few months back that they do not expect to operate higher than a break even going forward. So kind of in the backdrop of all this, we've seen in the last year or so, exchanges are really starting to lean into these banking products. They're starting to offer services like high yield savings accounts. We saw Gemini do this last year. Coinbase and Compound Labs both announced that they were going to do the same earlier this year. Exchanges are starting to offer lending programs. Clients can now borrow against their holdings and use their crypto as collateral for loans. exchanges are even getting banking licenses. We saw that Kraken got one back in September for a special purpose depository institution,
Mm,
SPDI license. And so what Kraken is doing with that, and what I think a lot of these exchanges are trying to start to get into is they're they're really trying to make the relationship, the banking relationship between digital assets and national currencies more compatible. With Kraken's license, clients can now pay bills or receive salaries in cryptocurrency. They can incorporate digital assets into their investment and trading portfolios. It's really a kind of side to crypto exchanges that we've never seen before, and it's very unique to crypto, and that other exchanges are not offering these kind of lending and banking services. So it's a really interesting spot. Demand is definitely there from clients, and we'll see what banks kind of do to respond.
yeah. So to some, I mean, one thing I know, like back in 2016, 2017, they used to get talked about a lot from kind of in institutional circles in cryptos. People thought it was very funny that exchanges would be custodians at the same time, because in traditional financial markets, that's a big no-no, right? But since then, that trend has almost continued along, right? And instead of separating custody from the exchanges themselves, they've actually layered on more and more services, right? So you pointed out there, Coinbase, I think this week rolled out a high yield savings account. Gemini's had one for a little while. So they're essentially doing like bank accounts in crypto. They're doing lending in crypto. They're essentially encompassing this wide range of financial services to the point where that doesn't really look like the model of an exchange. New York Stock Exchange doesn't give you interest on your savings that you sit with them, right? So that's just really interesting. Talk to us a little bit about. There's been some noise on kind of the traditional banking side of this, right? And there have been announcements that have come out that hey, X, Y, and Z bank is going to be able to offer to their customers the ability to they can buy Bitcoin through their bank. Talk to us a little bit about the movement that's going on the more traditional side of things.
Yeah, I mean, in the last 6 months to a year, we've seen institutional adaptation for crypto across the board. But with banks, especially, clients are coming to them and saying, we want to buy crypto. We want exposure to this asset class that's all over the news. I want these returns. Maybe not right now, but at the time, investors are really interested in it. So NYDIG is a big firm that's really starting to get involved in this space. They had two partnerships that came out earlier this month. Um, the first is with Fiserv. They're creating a software that would allow banks to have clients trade and buy crypto directly on their online banking apps. So you could go on your Bank of America app and buy Bitcoin, which would be pretty revolutionary. They also partnered with the National Cash Register to try to connect banks and credit unions with crypto trading services. And so these are all things that are kind of in the works. There's obviously a lot of questions with custody and security and kind of the details of how these things will work out. But the overall theme is that banks are definitely realizing that clients want exposure to these assets, and they don't always want to do it indirectly through Grayscale Bitcoin Trust or another exchange traded product like that. And a lot of times they don't want to do it through an exchange. I think that a lot of newer crypto investors have some fears around security and custody with exchanges.
So how do you see? I mean, do you see crypto exchanges kind of being competitive almost with banks in terms of making these offerings, or what is the different like customer profile of someone who would buy and hold through a bank versus a crypto exchange?
Yeah, I mean, I think that the clients right now are very different. I think that the client that is drawn to the exchange is someone who has not only high crypto holdings, but also a very high level understanding about the asset class. They are traders that understand arbitrage opportunities. They want decentralized finance opportunities with leveraging parachain auctions. They're traders that understand these concepts around crypto. They want to be able to stake, they want to borrow against their holdings. The average investor that's new to the asset class is not thinking about crypto in these terms quite yet. And,
Mm.
I think at the end of the day, the exchanges are really tailoring their services to the clients that understand kind of what's going on. And banks are starting to enter this space. I mean, I'm not sure what's going to happen in the next few years, but I think right now it is a very different clientele. And, exchanges, I think the major issue that exchanges face right now is they're very much geared towards traders and financial professionals. that are far beyond they're not within reach of the normal consumer, and their product today is not tailored to the broader consumer market,
Yeah.
whereas what the banks might be offering in the next few months would be.
So, Case, let's speculate a little bit here. So, you mentioned in that Coinbase S1 that 96% of Coinbase's revenues came from it's like transaction-based fees right now. I think Brian Armstrong came out and said, I forget, somewhere over the course of the next couple of years, he wants 50% of the revenue of Coinbase not to come from those transaction-based fees. It's going to come from things like staking, right? Lending, all those
Yes.
other products that we were talking about. Do you think that's realistic?
I don't think it's realistic in the next couple years. I think maybe 5 years. They have Coinbase Pro, which is their kind of advanced trader platform. It offers a lot of services that, again, the average trader doesn't want or need. They also have their institutional platforms. I think that, I wrote an article a few weeks back about the first 401k that's going to allow clients or investors to access crypto in their 401ks. They're
Mm-hmm.
using Coinbase to custody that. And I think we're going to see more and more of those deals, and more, maybe smaller banks are going to start to lean into crypto. And like I said, they're going to need a custodian. So I can see exchanges taking on more of that role, and that is going to be a lot of revenue.
Yeah. Yeah, absolutely. I mean, it's a great example of like a smaller bank that has become, a giant in the space already is Silvergate. The leadership of Alan Lane to steward a bank into doing what they've done in crypto is just frankly phenomenal. And the Sen and Sen leverage networks that they've built are like critical pieces of infrastructure for both exchanges and asset managers in this space. So, yeah, I think it'll be really
Definitely.
interesting. Yeah. Do you have any opinions on before we move on to our last topic here on like I guess when I kind of look at exchange like a traditional exchange business model, it's exactly what Coinbase kind of looks like today, which is they generate the majority of their revenues and profits through transaction based fees. What it looks like they're shifting to, I mean, one thing that I thought was pretty interesting in that Coinbase S1 is that they talked about the amount of assets that they have. And I get that they have a custody business, but what that almost feels more like it's like the discount brokerage model, where really what you're trying to, or bank model, where you're trying to gather up assets and then through like lending them out, it's like a net interest margin type business. So you have a bunch of assets and then you find ways to kind of somewhat passively, somewhat actively generate revenue on those assets. So when you think about the model of exchanges, like a couple of years out, how does it look? Does it look like a very transaction kind of based model? Are they doing more of these like banking type services? Like, paint me a picture here. Tell me the future, Casey. That's what I want to know.
I'm new to this space, but I see it going more in that direction. I definitely agree. And, like you said, these crypto exchanges are not operating like a typical like stock exchange. It's very different. It's a lot of services. Of course, a lot of that just comes with the nature of the asset class.
Hmm.
But, I think that we're only going to see increased demand from clients. I think that as institutional adoption grows, as investors start to want to gain exposure to this asset class, they're just going to be forced to offer more services. And I think that the demand is only going to go up.
Yeah,
Can I
absolutely.
give my historical perspective on this?
Hit
Of
us.
course.
So one of the biggest like themes in this next 10 years is transaction fees, right? And what we saw from the access to the public markets from like 30 years ago, where we used to trade in like eighths, right,
Hmm.
to half a penny now, and to actually free. Like, look what happened to Robinhood's whole business model once it dropped commissions to free. And what happens to Goldman Sachs and Morgan Stanley's research when they get paid they get paid really tiny commissions now to execute trades, is their research kind of sucks, right? Like, and that's a centralization problem. When you become a centralized player, you're at the whim of the price cutting, right? It's the Jeff Bezos, your margin's my opportunity. My point being, Jack Mallers just came out, was it 2 weeks ago, and he was like, I'm making Bitcoin transactions free, right? That absolutely kills the pricing power and commissions of these giant companies like Coinbase if it gains scale, right? And it's just like what happened with BlackRock when they cut their fees on ETFs, active management gets annihilated. And so you're basically opening up the on ramps to more and more people when the transaction costs drop. And the closer they get to zero, the more scale it is, right? So if you can get transaction costs to zero, that opens up everything. It's democratizing stuff, right? But you also get like that monopoly effect, like Robinhood does, right? If you drop it to zero, and then it creates these weird incentives. That might not be bad for Bitcoin though, because it's naturally decentralized. So like if you can gain access to everybody, then the volatility drops, everyone is an owner of this thing, and then you can create these ecosystems underlying it. But my point being is that Coinbase, if they can keep their trading fees up here, it would be just like so shocking. They're going to get so eaten up so that they'll have to basically create new products off it. And they probably will be able to because they have like a lot of assets in custody. But when you analyze it from the transaction cost perspective, it's really fascinating. And not only that, the banks are trying to do this stuff while their commissions are dog shit. And they're trying to get into it after the fact. Bank of America just hired a crypto team. It's like, dude, you're too late.
Yeah.
Maybe they're not, but like,
No,
it's just crazy to me.
well,
I would love to be a fly on the wall of like the big banks where they're like, oh my God, like what the hell do we do here? Like my business model is putting people in debt, right? And like, there's these other companies that could do it for cheaper.
Yeah, I will just say like a couple anecdotal things. When we started doing this in 2016, 2017, Jason and I took great pains to go out and meet people at Bank of America, Fidelity, all these big law firms because we wanted to get the institutional perspective. 6 months into that rally, every single one of them left to go join a startup. And that's already happening again. And I will say there have been conversations that I've had with people inside large institutions, been like, wow, you guys are extremely well informed. Like, I'm shocked that you know all this because you're not doing anything publicly. But then every once in a while, I'll have a conversation and be like, ooh, you guys are so behind, man, so behind. And, because crypto is just like, it's kind of this goofy space. Imagine how difficult it must be to be an investor in this space. You literally need to take a significant amount of your portfolio and put it in things called sushi and yam and stuff like that. Imagine how difficult that is just from a purely mental perspective. And then imagine you're trying to advise to make those decisions to some like 65-year-old white guy who like has it's just not going to work. It just doesn't quite work.
Let me present the question to you guys. And this is where like, if you are a baby boomer and inflation's at 5%, and the US 10-year treasury is at 1.36%, right? And would you buy that, from this perspective, would you buy that bond yielding 1.36% with inflation at 5%, or Dogecoin, which has unlimited upside?
All right, Casey, I'd love to get your opinions on Dogecoin. Imagine yourself as a boomer, first of all. All right, let's do that.
Well, I do have an anecdote. My dad texted me about a month ago and said, should I buy dog coin with a space in between? So he's not quite there yet. He does have some Bitcoin, but yeah, I don't know. I mean, I don't know. I don't know.
So
I just still think it's that crazy. I think if you have extra money laying around and you see like some of these like little tiny tokens go up 10x, you're like, would I rather lose money or put it in Dogecoin? I'm not saying that I think it's kind of a joke, but it kind of synopsizes the ethos of investing across generations and asset classes right now. Is like people think it's crazy that cryptocurrencies are doing this, but it's the same people that are losing money in real terms in other areas, and they don't even realize it. So like, who's the joke on?
That's a good question. Here, I kind of think that, I mean, most people aren't like what, I mean, even if you tried to describe losing money in real terms to people, that's almost like not super intuitive to people, right? They kind of, because people look at money in a very, people look at their assets in a very nominal type way. So I think
Yeah.
in order for people to actually start making those trade-offs in their minds,
I think millennials get it. In Zoomers,
I think the millennials get it better than the older generations, because it just feels less attainable to a younger generation. Like, we've talked about this a lot. You just can't buy a house anymore. That's not something you don't need to explain that to anyone. You're just like, what do you mean? What am I gonna do? Put $500,000 down for a house that's not even that great? What? It's just, you don't even think about it. I mean, so it's just the millennial generation and the Zoomers, they just know it intuitively. They're not looking at real yields. They're not thinking about it's just, my lifestyle's not affordable. I need to take more risks. It happens on a very,
their
that type of
wages
level.
go up 3% a year in housing and education and books, and like they all go up 10 to 15%. So it's like they get it because they're realizing that the American dream as they know it is so unattainable the longer they don't get paid those wages. So they have to go out on the super risk spectrum, and the Fed's forcing it, and the government. But boomers thinks it's stupid. So it's like that. Therein lies the opportunities. They're choking the float on these like legacy assets, and it just takes a tiny incremental dollar to create an asymmetric convexing payout over on this side in digital assets. Mm-hmm. I'll stop.
Well, I had this experience the other day. I'd been asked to explain the concept of Bitcoin to a coffee group of people in their kind of 60s. As happened to me a couple of times across the year. So I'm trying to think, like, how am I going to explain Bitcoin to this group of people? And actually, there were a couple of people who spent their whole career in finance. So this one guy who was like 65 years old, he instantly understood the value proposition. But his chief complaint was, well, why would I want the Federal Reserve to go away? They've had my back for 30 some years. And I was just like, wow, I can't really argue with that. They have had your back. And that's just a very different lived experience than I have had as someone coming from a different generation. So I can understand that perspective. Totally.
Yeah.
So
That's a great call. Like if you are an asset owner for 40 years, you see nothing wrong with, your house going up in value and your 401k going up in value because you're staying ahead of the inflation. But like they didn't have student loans and they in the same size.
Yeah. So we'll close this off, Case. I'm gonna pick on you to end this here. But so my parents were one of those. They were like high school sweethearts. Right? They actually got married while they were still in college. They did that. They did the meme thing. When how the meme, it's like what my parents were doing at 25 versus what I'm doing at 25. My parents were literally buying a house at 25. They were moving in. They were getting ready to have kids. All that kind of stuff. And back then, that was what you wanted to do. You wanted to like have a house, right? Then have kids, then move in. And Casey, I'm curious, like, how would you talk about the timeline for like your generation, right? When you're graduating school, like what are the milestones that you're kind of looking for, hoping to achieve, all that kind of stuff? Just speak for your whole generation, if that's okay.
Well, I think one of a big notable thing about younger generations is we have a lot more we switch jobs a lot more often. I think that our parents, Mike and I's parents' age, they had their career and they had their retirement fund and they were staying at the same job for 20, 30 years. And I think that that's very different now. But yeah, I mean, student loans are insane. The thought of buying a house, I mean, I'm 23. There's no way. My parents got married. My mom was 24 when she got married and they bought a house. And that's shocking. I mean, my rent, I can't. So yeah, I don't know. It's hard out
Yeah.
here.
Just very
I
different.
love that
Very
juxtaposition. Yeah.
Me too. Hopefully people got the meme reference there. All right, let's just last thing I want to touch on here is just commercial bank lending, which has actually hit record lows. Again, this is credit to Tyler because you were the one who pointed this chart out to me. But we'll link it in the show notes. But essentially, just the commercial bank lending in general since 2008 has basically been dropping like a straight, like a stone, to record low levels, even through like dips and bumps in the economy. And the reason why this is significant is because that's where actual M2 money supply is created. That's through commercial bank lending. So all of this money printer go burr memes and everything that you hear, that is M1 money supply. That's the Fed's money supply that they use with other commercial banks. But the dollars that you and I think of, that all gets created through commercial bank lending. So essentially, if you don't have commercial banks lending, you're not getting that money supply creation. And just a story that happened just this week was Wells Fargo announced that it will no longer offer personal lines of credit to customers. They're not accepting new applications, and they're closing down the accounts of those who already had a line of credit open with the bank. Now, this is kind of emblematic. I mean, it just kind of dovetails very nicely with this chart that you shared, Tyler. I will say that there are other, Wells Fargo has maintained other credit products for individuals, but those are basically revolving lines of credit or credit cards. So what they've essentially done is eliminated a cheaper option for debt and kept more expensive debt options open for individuals. But I think overall it just shows that they're deprioritizing their individual consumer lending businesses in general. So is it a colossal deal that Wells Fargo is doing this? Probably not. Does it dovetail kind of nicely with this narrative? And is it just more like emblematic of what's going on with banks in general? I think so. I'm curious what both of you guys think about this decrease in commercial bank lending.
Case, why don't you go first?
No, I think you should go first.
All right.
I need a minute.
Okay, so my general read on this is, so Wells Fargo had some fumbles because they, had a bunch of issues with the government and creating accounts and charging weird fees. So they got put in this black box from the government. And I think Bank of America and JP Morgan ate their lunch in terms of taking advantage of that, right? And so they grew way bigger, and Wells Fargo is still dealing with all this stuff. And I think their profitability went way down. So they're trying to close off the less profitable business lines, which is lines of credit, which is generally a lower rate of interest. And I think, we're probably talking 4% or something on a line of credit. Whereas if maybe that's even lower now with rates where they are. And then credit cards are astronomical. It's 16% you get off credit cards. So it's clearly hey, let's try to get more profitable and put the consumer more in debt, right? Instead of servicing when someone really needs the line of credit and then all that stuff, doing a good for the middle class. It really just is annihilating the middle class more and giving more debt at a higher interest rate to the people who don't need it, in my read. And therein lies the banking problems. I think they're going to have a really hard time doing that. If I can borrow money from Coinbase or BlockFi or any of these other players that are lending money now, why wouldn't I do that? BlockFi was 7. I think I borrowed at 7% against my ETH, and that's probably way better than a personal line of credit or a credit card debt at Wells Fargo. So I think they're going to get killed on this, really, unless they really start cranking out those loans somehow. But it's just a funny thing. It's a funny thing.
Yeah. I feel like one of the things that's happened in general with risk in financial markets, or financing in general, is a little bit different from other industries, right? Because it's, in a weird way, it's almost a utility. People need access to credit in order for the economy to work. So usually the way risk taking goes in business scenarios, if let's say I, as a co-founder of Blockworks, want to take risks and I leverage myself and borrow a bunch of money and I want to do this $10 million event and it all goes bust. I'm like, sorry. Well, you screwed up and your company's out of business now. In finance, it can't really work like that because policymakers and people in general, they don't want their businesses to fail because they can't get access to financing or credit. Or if your bank blows up and your business fails as a result of that, that really sucks, right? So there's a lot of protection. Now, on the other hand, banks, even though they have this utility-like function in economies, they still are private businesses as well. And the way that you generally make outsized returns is people want to take risk. And over time, there have been these kind of cycles, right? There was savings and loans, right? And where basically there wasn't a really good market for these like individual, lines of credit basically, and they went out of the highly regulated banking system into these little savings and loan institutions. They took too much risk and they blew up. So over time, what we've seen is a consolidation of risk. And what the policymakers have decided is that the bigger you are, the less risky your operations are. And what that's had the effect of doing is just massive, massive consolidation across the banking sector. And then it's just a business opportunity, right? So for these big banks, they don't give a shit about tiny little companies, not because they're terrible people, but because they're a tiny little customer. It's like the customer that for us spend whatever. There's an analogy to be made, right? It's like your smallest customers take up 80% of your time. So JP Morgan doesn't care about their Blockworks banking relationship. They care about their Amazon Web Services banking relationship, because it generates 5 orders of magnitudes more dollars for them. So I think it's just this, you can kind of see how it happens, but I think the consolidation in the banking sector and the elimination of these kind of smaller regional lenders is actually really detrimental to just entrepreneurship and real economic growth in general, I think.
Financing Blockworks doesn't matter to them. That doesn't matter to their bottom line. So putting the manpower behind or woman power behind lending to those types of businesses is like, who cares? We need to finance. Give me a $100 billion idea I can finance. That's the real news. So it's just like giant, projects. Yeah. So just come up with a really crazy giant project to have them finance for us. We'll do a SPAC.
Right. We'll do a SPAC. Speaking of SPACs, there have been. Let's close. Actually, I just didn't list this at the beginning, but there's some pretty interesting stuff going on in crypto land. 2 big SPACs coming out in crypto land. Casey, you want to talk a little bit about Circle or Bullish, or where do you want to start there?
I want to start with Bullish, but refresh my memory a little bit. There's no product. Is that correct?
Yeah.
Well, I think
you want to go round 2 on this debate here, my friends?
Yeah. All right. I'm going to be bullish. Mike is going to be bearish bullish.
Okay.
It's going to sound like nonsense. Bullish is the name of an exchange. So, for those who don't know. All right, Case, lay it out for us.
Okay, so Tom Farley's PAC is merging with Bullish to bring a planned crypto exchange public. Bullish is going public. So why are you bullish on Bullish, Tyler?
Okay, I think the main argument here is Bullish is coming out with a SPAC at $9 billion with no real product yet. It's in beta. If you look, normally I'd look at this and I'd be like, oh, that's a short, right? Like I'd probably be like, this is a joke. But you have Tom Farley, who is the ex-president at NYSE and at ICE, right? This guy knows exchanges inside and out. He's the president. Then you got the Block 1 guy as the chair. And you're backed by Peter Thiel, Alan Howard, there's a couple other guys, Mike Novogratz, Rich Lee, and the guy, he does the European guy, big macro investors, right? That are rarely wrong, right? I don't think they'd overvalue something that didn't have a tangible use case. My guess is what's happening behind the scenes is this. They are basically lining up institutional staking and yield generation, and they probably have CalPERS and CalSTRS and all these Canadian pension plans already kind of verbally okay, ready to go to basically stake their coins and get 10% yield. And basically they need all this yield to satisfy all their pensions. And there's no real institutional option for that right now. That's the security's there. I bet you they've been building all that and getting ready for it, and they're going to launch with it, and it's going to be a raging success. You don't get that many good investors and controllers in one spot.
No, that is a good point. So Tyler thinks there's a lot going on behind the scenes. Mike, why are you bearish on Bullish?
Okay, why am I bearish on Bullish? I'm going to give you two case. One is my actual case, and then maybe I'm going to take the less generous side of the argument that Tyler just laid out there. But I think in general, in crypto, there's this idea of cathedrals versus bazaars. And actually, before we get into what that actually means, there's this kind of interesting psych study that's been done, basically, they're trying to determine if thought process or experience is a better judge of doing a task. So they take two groups of people, basically, and they have this task, no experience, like building clay pottery or anything like that. And they're like, okay, to this one group, you have an hour. I want you to think about what is the best way that you could design this like vase or something like that. You only get to create one, but you have all this time to think. And then for the next group of people, they're just like, make as many vases as you can over the course of the next hour, go. And almost invariably what ends up happening is the better vases come from the people that just are making as many vases as they possibly can. And the idea there being experience really is the best teacher. Fred Wilson also has another way of saying this, which is you make your own luck, which is just by getting out there and doing things in a business sense, listening to your customers, you're going to end up doing a much, much better job than all of the thinking and money in the world because you're actually out there getting real experience and communicating with your customers. So the idea of a cathedral versus a bazaar, not to poo-poo any projects, but there was a very well-known, very well-backed protocol that has recently been renamed and just launched that was like all the rage back in 2017, had all of these illustrious investors. It was like the talk of the town. Everyone wanted to get in on this thing. And the mainnet just kind of went live under a new name, and nothing's really happened except that it's dropped 90% and nobody's using it. So as opposed to protocols that are doing very, very similar things that just launched with a minimum viable product and got people using them, those are actually doing very well. So in general, when I kind of look at something like Bullish, it's like there's no product. I get it. There's a lot of money. I just don't really see how they're going to do it. I don't see the road to success. And I will actually paint the less generous version, Tyler, of what you just laid out, which is in an ideal scenario, they've got all these pensions that are ready to like yield farm and stake and do all this stuff, yada, yada. Here's another interpretation.
There's no yield in the public market.
Here's another. I'm sorry if you're listening to this.
Trillions of dollars.
So Bullish comes from EOS. Mike Novogratz owns about 25% of all those EOS tokens out there. Mike Novogratz goes to a couple of buddies of his that don't know so much about crypto. He says, hey, this exchange, this
Peter
is the
Thiel?
one.
Peter Thiel?
I gotta think that's how it works. You're the one who told me millionaires use data, billionaires use astrology. And you know what else billionaires do? They trust their buddies. And they don't do a whole lot of due diligence. So I kind of think it's like, hey, man, this is the one, this exchange.
Wait, you think
then you get knocked
Mike
down another name.
Novogratz swindled them into this investment?
Well, no, I do not think anyone is swindling. I think it's best of intentions. Like lots of good investments are put together this way. I would just suggest that a lot of these people that are making these investments maybe are doing it off the recommendations of friends instead of super active due diligence.
I would normally agree with you, but this specific group of billionaires does not do astrology investing. It's not like they're like real estate investors. These guys are like, they're legit. Like, yeah. Alan Howard's been in crypto for years. So the same with Peter Thiel, same with Novo. Like these guys aren't just coming in like, hey, I'm going to pile on. They've seen the entire progression of this stuff. So I don't know. I'm still bullish. All
right. I'm gonna say that I'm bearish bullish, but I wish I had come up with examples off the top of my head, but it's just there have been other high profile projects that people have poured money into. There was this marquee list of investors, and then it was like, nah, dude, nah. And that's that's
Cuban
that's human
just
nature.
Lost on that stablecoin thing. So, I mean, there are, we'll see how it plays out.
I give a lot of credit to Cuban for wading into a space where there's not a lot of upside because there's a lot of reputational downside still to be had. He took a bit of a risk. He went out there, and yeah, this particular one didn't really work out. But I have a lot of respect for guys doing stuff like that. And I'm not, by the way, this is all in good fun. Bullish might be a huge success. I'm not rooting for anyone's failure. I'm just...
Bullish, if you want some ad dollars, if you want to place... Just...
All right. What's everybody's weekend plan, White Shirt Gang? What are we doing in our white shirts?
It's my roommate's birthday, so she has in our what is it, like a 400 square feet. Our apartment's really small, and she has 3 friends visiting, so it's gonna be fun. We
The
won't be
New York
spending a lot of time at home. I know, I hope the
That's
rain
like,
stops. It's gonna be good.
yeah, I think it is. It's looking nicer out right now.
Yeah, I think so. The Elsa's passed, hopefully.
Hopefully. Tyler, what about you, man? Tell us about your typical dad weekend these days.
Yeah. Let's see. Mowing the lawn.
Do you have New Balance sneakers to do that?
There's this new Disney movie. Yeah, I got some sweet New Balances. You know, that my friends call them shit kickers. They're like grass stained. It's just great look. But yeah, we also watch. You guys probably don't get this yet, but Disney. You know how like you don't really watch Disney or any of that stuff for pretty much from the time you're a teenager till like young professional. Once you have kids, it's like crack cocaine for these things, and they're like, oh, I want to watch Luca. Like Luca's the new thing that just came out, or like Monsters Inc. And they're captivated by it, and you get why like Disney is such a huge corporation. So
Because they just love this stuff. Yeah.
What's
but
their favorite
yeah,
right now?
Luca. It's this
Oh,
new.
I
He's
hadn't
half,
even heard of Luca.
he's
I
half
hadn't
sea
even heard of
monster and he's half human. When he gets out of the water, he turns human, and he lives in a
Is
little.
it a movie or a show?
It's a movie. It's like the
Oh,
new. Normally, it would have been huge if the pandemic wasn't happening, but they went direct through streaming instead of like the movie. So
Yeah.
check it out.
you have
Disney
Disney
cr-
Plus, I'm
I've seen it about
assuming.
50 times already.
Yeah.
Oh God, Disney does crush it. I mean, even the Marvel movies, they're like extremely watchable. I would characterize them. I've been watching the Loki. I don't know if other people have been watching that. That should be a surprise to no one that I'm a huge nerd and I like these comic book type movies. But yeah, it's not bad. It's not bad.
Case, what's your go-to movies?
We do a lot of reality television in my apartment, not a lot of movies, but I was a nanny for like 5 years in high school and I saw pretty much all the Pixar movies, and I agree, they are pretty good. Maybe not good on like the 10th watch because kids like to repeat them, but the first few watches, they are pretty good.
I agree.
All right, guys, let's wrap it there. This was a good roundup. Thanks, Case, for joining us, spicing it up a little bit.
I know, thanks
This
for
was a lot
having
of
me.
fun. Yeah, we'll do it again
Lots of
soon.
fun.